inventory? Inventory refers to a company's product from raw material until they become finished goods. Inventory is also known as stock. The company either uses these materials or products for manufacturing or sells them in the market to generate income. There are 4 types of inventory, which is raw materials, work in progress, merchandise and supplies, and finished goods.
The audit objective for the assistant is to verify that some of the classes of transaction and relevant account are comparable, purchase return, account receivable, cost of goods sold, and inventory. Internal control for assistant. The first is to make a proper separation of duty and physical safeguard of inventory to prevent replication inventory. Second, use pre-number or properly approved receiving record and material requisition for inventory transfer. The last one is internal verification by qualified and unbiased individuals and depend on relevant documentation and record from the physical inventory count. Audit procedures for audit of cost accounting. For test of control, select random sample of the numbers and identify the tag with the number attached to the actual inventory. Second, observe whether movement of inventory takes place during the count. For a substantive test, the purpose is to uncover the inclusion of non-existent item as inventory. For audit of pricing and calculation, test of control is trace inventory listed in the schedule to inventory tax and auditor recorded counts for assistant and description. Substantive test. First, the next 5 objectives are affected by the result of physical inventory observation. Second, the tag numbers and counts verified as a part of physical inventory observation and traced to the inventory listing schedule as a part of this test. Next is audit evidence of
obtained to match with
physical
sales and
inventory,
inventory
human
purchases
resource
are
parts,
recorded in the proper
inventory
audit
journal,
objective.
inventory
To
transaction
check
file,
whether the
and
sales and
traditional
inventory
and
purchases
system
are
documents.
recorded in the proper class of
The
transaction and
statement of
relevant
the
account.
assistant are
The
offer
first
or
one, we have raw
understated in
material account,
inventory
direct
account,
labor account,
of
manufacturing
current
account,
asset,
finished good account,
and
payable
obsolete
account,
inventory
receivable
not
account,
properly
inventory
identified.
account, and purchase internal control. Record transaction date as soon as possible after goods and services has been received and follow the correct accounting period. Next, all employer contributions for the year have been properly recorded, even if received in the substantive test. Compare dates of receiving report and vendors' invoices with sales in the acquisition journal. Test of control. Examine procedure manual and observe whether unrecorded vendor invoices exist on inventory. Cost of accounting period and perpetual inventory must have possible misstatement. Improper sales and inventory purchase dates and unrecorded inventory.
Next, we will look at the class of transaction and relevant accounts. There are 2 audits related to the inventory and warehousing cycle, which are the audit for cost accounting and also finished goods account, inventory account, and finally for cost accounting, the audit objective is to make sure all the inventories that are purchased are properly recorded. And the second one is that all existing inventory is counted, tagged, and taxed. Internal controls must be done by the client. For example, all relevant documents such as inventory acquisition, receipt schedule, purchase order, there are 2 audits related to the inventory numbered and recorded. This is so that there will be no missing documents and that if they are missing, they can be easily tracked. Then a physical count of the inventory must be done at least once a year, and an auditor should be present during the physical count. And finally, a knowledgeable client should have a formal review and reporting of obsolete, slow-moving, damaged, and overstated inventory items. Firstly, we will look at the cost accounting. So the test of control is that number 1, examine inventory to make sure it is tagged. Then number 2, observe whether movement of inventory takes place. Next, we will look at the audit evidence, which is related with the assertion of completeness. There are 5 of them, which are vendor's invoice, purchase requisition, purchase order, receivable record, and finally, and then number 4, account for all used and unused tax. This is to make sure that none are lost or intentionally omitted. And then number 5, report tag numbers for those used and unused for subsequent follow-up. For audit of pricing and evaluation, the first test of control completed tax records of the current we must account with unused tag numbers and show to the auditor's documentation to make sure no tax system will be. There are 2 possible mistakes. And then for second one is on trace, which are number 1 to overstatement or understatement of inventory schedule. So make sure that number 2 on overstatement or understatement of unit cost of inventory. And then finally, account for tax numbers to make sure for listening. I will now let the auditor compare the financial records of the previous period record with the current accounting.
Storing, issuing, and recording inventory. Next, we can maintain detailed documentation for all inventory transaction, including classification changes. Next, we can provide regular training procedure we have involved in inventory management and accounting for audit on classification policies and process of control. Examine inventory description on the tax and compare with the actual inventory for raw material, work in process, and finished goods. Next, we can evaluate whether the percent of the completion recorded on the tax for work in process is reasonable. The next one is substantive tests. For audit of pricing and calculation, sample test of inventory items, verify the classification using raw materials, to inventory records and financial statements to verify the description on inventory tags and auditors recorded tests, count with inventory listing schedule. And for substantive tests, select a sample of inventory evidence we have and trace them from sales invoice to inventory records, supply invoice statement to verify inventory files. The last one is possible misstatement. The first one is overstatement or understatement of inventory and cost of goods sold, such as misclassification of between inventory categories. The second one is overstatement of sales and understatement of inventory, such as incorrect classification of return goods.
As for
Next is
class of
audit
transaction and
procedure.
relevant account,
For test
the
of
first one is
control,
vendors
inquire
invoice,
about
purchase
items that are
account,
likely
payable
to be
account,
damaged.
requisition account, and
Secondly,
costing
discuss
inventory
with
record.
management the reasons for excluding any materials item. Thirdly, test for obsolete inventory by inquiry of factory employees and management. And fourthly, observe the condition of the inventory that may be obsolete, slow moving, or in excess quantities. And for substantive tests, determine the quantity of damaged merchandise during inventory
As for
calculation.
procedure of
And
cost
the
accounting
for
for
inventory that
evidence,
is
first
obsolete,
is test of
damaged,
control,
or located in realizable value
of
at
customer
places.
inventory
Firstly,
code
perpetual
event.
inventory
On
must
next
one
one
is
is
realizable value.
the
Audit objectives for auditor to audit transaction inventory realizable value is to figure out whether any inventory goods have become obsolete or irrelevant. There are four classes of transaction and relevant account related to realizable value. Firstly, accounts payable. Secondly, cost of goods sold. Thirdly, accounts receivable. And fourthly, sales return. Internally control for inventory realizable value. Inventory means the absolute value of inventory for obsolete or excess inventory. Secondly, perpetual inventory master files are managed by people who do not have custody or access to assets. Thirdly, periodic or annual comparison of goods on hand with perpetual inventory records.
Identified as non-owned during the physical observation to the inventory and listing scheduled to make these have not been included. So the cost, what we can do is cost testing, which is verify the cost of inventory items. The second is lower of cost or non-realizable value testing, which is ensure the inventory is valued at the lower of cost or the net realizable value. The next one is the audit evidence, which is the first one is
Possible misstatements that usually happen in inventory realizable value is overstatement or understatement the inventory.
Which is purchase order, invoice, and shipping documents demonstrating the ownerships, and the physical inspection, which is evident from physical observation of inventory counts, Then lastly is possible agreement, which is the communication of consignment of inventory, showing inventory is not inventory to the entity does not legally own is included in the inventory balance. The second is understatement of liabilities. Obligations related to inventory such as consignment inventory payables are not recorded. And misclassification, which is inventory held on consignment is incorrectly classified as the entity's inventory. So,
Mandatory declaration deal with whether the inventory have been included in the financial statement at every amount. For the audit objective, it was to check whether the management are using the correct price to value the inventory and to obtain documentation that indicated physical examination was made. There is four classification of transaction and relevant account. First and foremost is vendor invoice. The second one is manufacturing account, and the third one is costing inventory record, and the last one is finished good account. For control purposes, it is important to recount the client inventory counts to ensure accuracy. This involves double checking the counts record on the inventory tags against the actual quantities of the item present. The maintain effective internal control. It is important to compare the physical count of inventory with the perpetual inventory master file. The perpetual inventory master file is a record that continuously tracks inventory movements such as purchases, sales, and adjustment. Observing the physical count is a test of control used to ensure the accuracy of inventory record. Testing the accuracy of inventory record involves verifying that the recorded inventory level match the actual physical inventory on hand. The substantive test, they need to trace inventory listed in the schedule to inventory tags and auditors recorded counts for the quantity and description, and also perform price test of inventory. Reconciliation of documents are amended using the auditing to verify the accuracy and completeness of financial information. This process involves comparing different sets of documents of record to ensure they match up and agree with each other. A perpetual inventory master file is a comprehensive record that continuously tracks inventory movements with a company.
Other than that, receiving report is a document generated with it when a company receives good or service from a supplier. It typically includes details such as quantity, description, condition, and sometimes the price of the item received. Possible misstatement. The fact is our statements are underestimate of unit cost which may affect inventory and cost of goods sold. It is over or understatement of inventory. Inventory is inaccurately recorded by the custodian if no supervision are presented.
This is 5 activities of inventories and warehousing cycle. The first one is acquire and record raw materials, labor and overhead. Function is to obtain an understanding of internal control, first processing purchase order, receiving raw material and storing raw material. Auditors perform tests of controls and substantive tests of transactions in both the acquisition and payment cycle and the payroll and personnel cycle. Next, physically observe inventory. Determine recorded inventory actually exists at the balance sheet data is correctly counted by the client. Essential type of evidence used to verify the existence and count of inventory.